Every year, lakhs of salaried Indians do the right thing. They earn, they save, some of them even invest now. And every year, quietly, without anyone making any announcement, the government takes a portion of that money back. Not illegally, not unfairly, completely within the rules. Because the rules exist. Most people just never read them. There is a legal way to save up around 46,000 in taxes every single year. Not a loophole, not a trick, something the Income Tax Act has explicitly put there for people who know to use it. After 8 videos of building your financial foundation, today we talk about how to stop giving away money you were never supposed to. Here's something that should make you uncomfortable. Your employer deducts TDS every month, that is tax deducted at source. It shows up in your salary slip. A quiet number, you ignore it. Over a year, if you're earning somewhere around 8 to 10 lakhs, that TDS could be anywhere from 50,000 to 1,20,000 or more, gone before the money even reaches your account. Now, here's the part that stings. A portion of that money, 46,800 to be exact, you were never supposed to pay. The Income Tax Act, Section 80C, gives every taxpayer a deduction of up to 1,50,000 per year. Use it fully at 30% tax slab and you save 46,800. At 20% tax slab, you save 31,200. At 10%, you save 15,600. That is not bonus. That is not luck. That is money that was always yours. You just didn't claim it. Why doesn't anyone tell you this clearly? Because the system doesn't need you to know. The TDS gets collected either way. Whether you claim the deduction or not, your employer deducts first. The refund only comes to you if you file correctly, if you know what to claim. Most people don't. So, most people don't get it back. Section 80C is the most powerful tax tool available to a salaried Indian. It allows you to reduce your taxable income by around 1,50,000 per year. Let that sink in. It is not your tax, it is your taxable income. 1,50,000 of what you earn simply doesn't get counted for tax purposes. What qualifies for Section 80C? Things you're probably already doing or paying for. EPF, Employees Provident Fund. Your employer deducts this from your salary every month. That amount already goes towards your 80C limit. Check your payslip. PPF, Public Provident Fund, government backed, 7.1% interest, tax free returns, 15-year lock in. Safe, boring, genuinely good for long term wealth. Life insurance premium. If you pay for a term plan, which after video 7 you should, the premium qualifies under 80C. Children's tuition fee. If you have children in school, their tuition fee counts. Home loan principal payment. If you are repaying a home loan, the principal portion qualifies here. NSC, National Savings Certificate. Tax-free saving FD. All of these counts. And then, the one that most investors in the series should be using now. ELSS, Equity Linked Savings Scheme. This is the only 80C instrument that also works as an investment. Everything else on the list either locks away money for 5 to 15 years or gives you a safe but inflation matching returns. ELSS invests in equities, the same market as we discussed in video 6, and has the shortest lock in of any 80C instrument, that is just 3 years. One vehicle, two benefits. Tax saving today, wealth creation tomorrow. Every other 80C option gives you one thing. ELSS gives you three. 1. Tax deduction. Invest up to 1,50,000 in ELSS. The amount is deducted from your taxable income immediately. This year's tax lowered. Second, market returns. ELSS fund invest in equities. Just like the Nifty 50 index fund we set up in video 8. Historically, they have returned around 12 to 15% over the long term. Not guaranteed, but simply better than 7 to 8% you would get from tax saving FD or PPF. 3. The shortest lock in under 80C. 3 years, that's it. Compare that to PPF, that is 15 years. Tax saving FD, that's 5 years. NSC, 5 years again. 3 years, and your money is free to stay invested or to be redeemed. Here's the compounding math that matters. If you invest 1 lakh 50 in ELSS every year for 10 years at an assumed rate of 12% return, total invested would be 15 lakhs. Value at the year 10, approximately 29 lakhs. Tax saved over 10 years. Considering it is a 20% slab, would be 3.12 lakhs. You didn't earn returns. You earn returns on the money you would have otherwise paid in taxes. That's compounding advantage which nobody puts on the table. One important note on ELSS taxation. When you redeem after 3 years, gains above 1.25 lakhs per year are taxed at 10% LTCG, long-term capital gains. This is still significantly lower than the income tax rate most salaried people pay. So even on exit, ELSS is tax efficient. You save taxes going in, you pay less taxes coming out. ATC is the headline, but it is not the whole story. Most salaried Indians qualify for additional deductions they have never claimed. Here are the three most commonly missed. Section 80D, Health Insurance Premium. We covered health insurance in video 7. Here's the tax angle. The premium you pay for your own health insurance, deductible up to 25,000 per year under Section 80D. If you pay for your parents, an additional 25,000 or 50,000 if they are senior citizens. The total possible ATD deduction is around 75,000 per year. At 20% slab rate, 15,000 saved every year. For insurance, you should already have. Section 80 CCD 1B, NPS extra deduction. NPS, National Pension Scheme, allows an additional deduction of 50,000 per year, above 1,50,000 under Section 80C limit. This is separate, additional, on top. Invest 50,000 in NPS, get 50,000 deducted from taxable income. At 20% slab, it is 10,000 saved for money that goes towards your retirement. Section 24B, Home Loan Interest. If you are repaying a home loan, the interest portion up to 2 lakh per year is deductible under Section 24B. Note, this is the interest, not the principal. The principal goes under 80C. The interest goes here. Two separate deductions, one loan. Now let's add for typical scenario. Section 80C, around 1 lakh 50. 80D, health insurance, around 25. 80CCD, NPS, extra, 50,000. Standard deduction, which is automatic, 75,000. Total deduction, 3 lakh. If you earn 10 lakhs per year, your taxable income just becomes 7 lakh. Your entire tax liability shifted downward, potentially into a lower slab entirely. Here's the decision you cannot avoid in 24-25: old tax regime or new tax regime. This is where most salaried Indians either get it wrong or leave it to their CAs to decide without understanding why. Let me make this simple. New tax regime. Lower tax rates but almost no deductions. You cannot claim ATC, you cannot claim ATD, no HRA, no LTA. The rates are lower but your full income is taxed. Old regime, higher tax rates but all deductions apply. ATC, ATD, ATCCD, HRA, home loan interest, standard deduction, all of it. Your taxable income shrinks significantly. So which one wins? It depends entirely on how much you invest and how much you claim. The break even is roughly this. If your total deductions, ATC plus ATD plus HRA plus others, exceed 3.75 lakhs per year, the old regime saves you more money. If your deductions are below, or if you don't claim any in new regime, is better because of lower rates. Here's the comfortable truth. Most people default to the new regime because it is default now. No action required, no forms filled. But if you're watching the series, if you have emergency fund as ELSS SIP, a health insurance plan, or a NPS contribution, your deductions probably cross that threshold. You are leaving money on the table by not switching to the old regime and claiming what's yours. Check with a CA or use income tax department's own calculator. It takes 10 minutes. The answer could save you 20 to 50,000 this year. One more thing every investor needs to know before we close. What happens when you eventually sell your index fund or ELSS units? LTCG, that is long term capital gains tax. If you hold equity mutual funds or stocks for more than 1 year and then sell them, your gains are subject to LTCG at 10%. But here's the rule that protects small investors. The first 1,25,000 of LTCG per year is completely tax free. So if your gains in the year are 80,000, you pay zero tax. If your gains are 2 lakhs, you pay 10% only on 75,000. That is 7,500 of tax on 2 lakhs of profit. This is why systematic withdrawal over multiple years is smarter than redeeming everything in one go. Stay within 1,25,000 of gains per year wherever possible and you exit it essentially tax free. STCG, short term capital gains. It is different. If you sell equity held for less than 1 year, your gains are taxed at 20%. The lesson? Time in the market protects you twice. One through compounding and one through LTCG exemption. Hold longer, pay less, earn more. Let's go back to the beginning. There is money being deducted from your salary every month. That part you cannot change. But there is also money sitting in the Income Tax Act waiting for you to claim it back. Around 46,000. It is not a small number. It is 6 months of 500 SIP. It is a year of health insurance for your family. It is the first step towards your 1 crore retirement corpus. The system isn't designed to remind you. The system works fine either way. But you know now. And knowing is the entire difference between someone who builds wealth and someone who earns well but never gets ahead. Your action steps right now. Step 1. Check your Form 16 or payslip. How much ATC have you already used through your EPF? How much room is left before 1,50,000? Step 2. Open Grow or Zero the coin. Search ELSS. Pick a direct growth fund. Start an SIP for the remaining ATC room. Step 3. Declare 80D. If you have health insurance, submit the proof to your employer's payroll team before the year ends. It reduces your TDS immediately. Step 4. Run the old versus new regime calculator. Go to incometax.gov.in. 10 minutes, the result might surprise you. Step 5. When you file your ITR, don't skip deductions or tell your CA exactly what you have invested in so they can claim everything you have entitled to. Comment below. Which deduction did you not know about before this? I'll reply to every comment this week. And if the series is helping you build something real, subscribe because video 10 is about goals, not abstract goals, specific ones. A house, a retirement, your child's education, and the exact numbers you need to start working towards each one. This is not a motivation, this is a math. Until then, invest in yourself. Comment if it hits different. Hit the like button, share it with someone who needs a money reset, subscribe for new video and see you next time.